This is the Portfolio Coach Podcast, featuring Derek Davis, founder and CEO of Portfolio Coach. For more than 30 years, Derek and his wife Jennifer have been coaching their high net worth clients to financial prosperity.
Hey, everybody. Welcome back to the Portfolio Podcast, Portfolio Coach Podcast, I should say. This is Kurt, and I have Derek Davis here with us again. Derek, welcome, and it's nice to talk to you again. And today we're going to get into some interesting stuff. We're going to be a little bit heady on today's episode.
That'll be fun.
Let's jump into the idea of fundamentals today. We've talked a lot in our previous podcasts and information on the website and ads that you see on social media and otherwise about why Portfolio Coach is an easy, simple, effective, efficient way for the non-millionaire investor to grow their wealth. Whether you got $500 or you got $500,000, Portfolio Coach is a way to help you grow to the place where an RIA, a registered investment advisor firm like yours, could take their millions and make them multi-millions. But Portfolio Coach is for the average person that has a few extra bucks and wants to be smart about the way they invest their money and wants to be able to do it. Maybe do it themselves because they're intrigued by it, or maybe they just need to dip their toe in the water because they don't quite know what investing is about, or maybe they're skeptical that RIAs will make more money than them. But whatever the reason, that's where Portfolio Coach comes in. But I think we got to talk about fundamentals a little bit, because the Portfolio Coach methodology, the algorithm, the quant, it actually produces really great results. 15+% returns on average over the you're beating the S&P over and over and over every year. But why? Let's talk about that a little bit today. Let's dive into the fundamentals. What is it that a person has to know? In this case, Portfolio Coach knows for you in order to be a successful investor.
Yeah, so it starts with the team, I guess. And so let's say you decide to go with a fundamentally based team, and let's say it's the high beta team. What our analysts do here is we'll look for stocks that have high beta. So what is beta? So the stock market trades at a certain level. Some stocks trade much bigger, go up much faster and go down much faster. Those have high beta. Some stocks go up much slower and go down much slower. Those stocks are low beta. So a high beta stock might be are generally focused on technology, new generation, not necessarily a lot of profitability. A low beta stock is going to be a McDonald's, a J&J, a Home Depot. A high beta stock will be a Tesla, a Coinbase, an Upstart, a Datadog, Lemonade, all these kind of startup stocks that are growing quickly. And so those stocks tend to do very well when they start out. As far as stock price, although their PE, which is another fundamental thing we look at, which is price to earnings. So a typical stock that might have a earnings of $1 a share would trade at $15 would be their stock price. That would be a 15 times PE. And so with a 15 times PE, you're kind of right there at the low end of historical values. What has happened recently is the Netflix of the world and a couple other ones out there have gotten to a 60 or 80 times PE. So what you're going to have to do is you're going to have to wait years for their earnings to double, quadruple, even go 8 times before that, that 60 times becomes 15 or 18 to typically where we would consider that a good value. So that's kind of where we are as far as what is beta, I guess.
So you're using some insider terms there, and so let's break some of those down a little bit. You talk about PE, which is the price to earnings ratio. Let's break that down a little bit so that maybe if I'm a little bit new to the game, maybe if I'm just dipping my toe in the water with my first $1,000 or whatever with Portfolio Coach, Let's break those down just a little bit for understanding. And one thing I want to come back to that you started with, Derek, when you're talking about teams, you're talking about how Portfolio Coach functions. The Portfolio Coach, you have a portfolio, and we call them teams. And a team consists of players. So a team is a portfolio, quote unquote, that you've heard over the years. And then the players, as if you were on a sports team or some other type of team, the players are the individual stocks. So the individual stocks within the team are what your quant and your algorithm is assessing on an active basis to tell me whether I should buy, trade, buy, sell, hold. So for those of you who are listening and not quite connecting there, remember that that's how Portfolio Coach works. You have teams that have players. Those players are actively entered or exited from the roster on a daily basis so that when the market goes down, you don't lose as much. And when the market goes up, you get gains. So let's talk about a couple of those things. You talk about PE ratios, you talk about multiples and 8, 12, 15, and 80. Take us a little deeper on that. Why is that important? And how does Portfolio Coach solve that problem for me so that I don't have to be an expert in that in order to generate wealth from my investments?
So, let's start out at a 10,000 foot view, right? Everybody, it's the S&P 500. Okay, it has 500 stocks, so it looks at the broader market. Right now, if you add up the earnings of the S&P 500, it's real close to $200. Now, if you're going to trade at 20 times, the fair value for the S&P 500 would be 4,000. If it's trading at 16 times the 200, then it would be at 3,200. And this is actually the value of the S&P 500 when you look it up on CNBC or Yahoo Finance or Google Finance. That's the price of the S&P 500. Now, as you drill down and you look at a stock like Apple. So Apple has historically done very well. And so it has a higher PE than perhaps the average. So if a historical fair value multiplier on Apple might be $22 a share. So if Apple's making $10 a share, 22 times means Apple should be trading at $220 a share. And that would be the fair value of Apple. Whereas something like a Walmart or let's use J&J for an example, they are more consistent with their share but have less growth, so they're going to be a less multiple. So let's say they're at $15 a share. Let's say they're making the same $10 a share that Apple was making, but their multiple at 15 times is going to leave their fair price at $150. And then what our quant and algo will do is look and see when stocks are oversold or overbought, as well as the momentum as far as looking at trading volumes. And if Apple's trading at 30 times its earnings, then perhaps and there's less buyers, then perhaps we should sell it and wait for it to get back to its average. Whereas J&J is trading at 10 times. Well, historically, it trades at 15 times. How are we going to get up there? Let's buy it and allow the buyers to come in and get it back to everything reverts to its mean. And we've seen that certainly in the last 6 months, probably more so than anything. There was a lot of money thrown into the system or sent out by the government, and a lot of people bought a lot of stocks, and those multiples got really high. And over the last 6 months, we've seen a retracement of 30%. And now what that means is instead of 30 times earnings, we're down 30%. So now we're at 21 times earnings, and we still need to go down to maybe 18 times earnings on a historical basis. And the NASDAQ's going to have a higher multiplier than the S&P 500, which is going to have a higher multiplier than the Dow, because those are the big stocks that can't grow really quickly. They're not going to double their revenues next year like a Lemonade or a Datadog might do. So they're the
100-year-old, 200-year-old companies. Yeah, those 200-year-old companies are just slower moving, right? They can only get so big so quick, and they're proven.
If they were locked into that same 15 times ratio, and they were growing their earnings at 8% a year, and they were locked into that 15%. Then their stock price would grow at 8%. So that's kind of how PE works in setting the price of a stock, the fair value price of a stock.
So I've heard some people argue that PE doesn't even matter anymore. It's not even worth looking at because the PE ratios have gotten so inflated in some of these massive companies like Netflix or some people made that argument about Apple, and then they realized how much cash they had on hand, and they're like, oh, maybe it's undervalued a little, even though it has IP. So does PE matter? People are saying that the price to earnings ratio doesn't matter anymore because there's so much inflation in that value in some of these high-flying tech companies.
Yeah, I heard from a lot of those people middle of last year. We should reach out to them and see what they say this year because the companies that were at 60 times are now at 20 times because they lost 67% of their stock price. So there are certain things that don't have that are negative, have negative earnings, and so their PE is negative at this point, which doesn't make a lot of sense. They're going to have to, those are the startup companies, and we do, invest in a lot of startup companies because they're growing so fast that they're going to grow into profitability. So, Amazon, Apple, Microsoft, Google, they didn't always make money. They all started off losing money when they went public, and then over the course of time, now they print money. They do a great job, and they have a lot of cash in their balance sheet. So
I think you've just inspired another episode of understanding how companies grow. I think it's very unknown to the average person in the population, and not because of a lack of intelligence, just because there's a certain specialty that comes from doing what you do every day, watching this every day, being in a business environment, understanding startup, understanding growth stage, understanding maturity, understanding the end of the life cycle of a business if that happens. And we love to see big pops. It's exciting. It's thrilling when a stock pops this really big price and becomes newsworthy. But there's a lot of years in those companies where they're operating at a loss. And if it wasn't for investors infusing money into the business, they couldn't survive.
Very, very true. I mean, there was, I read an article 20 years ago, probably in the 90s. Apple was going bankrupt, and Microsoft is the one that bailed them out. And that was to keep Microsoft from becoming, the only player in the game. And then Congress was going to come after Microsoft, so they wanted to have another player. So it's real interesting to, now they compete against each other, and everybody thinks that Apple and Microsoft don't get along, but they were in. That's how Apple's existed, I guess, during some tough times in the 90s.
Yeah, and again, that's probably a podcast for another day. But competition, right? How competition can affect share prices, how competition can affect business operations, how business operations affect profitability, how profitability affects the attractiveness of an investment, affects your PE, affects the other fundamentals. So great. So thanks for taking us through that on PE. In my finance training in college, that was the number. My mentor, that was the number one metric. And he had a strategy. He would set a cap on the Dow, and he said, and he no matter what, he had extreme discipline. It was remarkable, his discipline. Even when he knew the market was going to go higher, when it reached his cap on the Dow, he came out and he went to cash. And everybody said that he was crazy for doing that because the market he'd missed a couple of massive market run-ups. What they didn't admit to, and what they didn't have a conversation and follow-up was, when he watched that go up another 20% and everybody was buying Lamborghinis, nobody ever came to him when they were selling the Lamborghini because they lost way, way, way too much and he was in cash. So every time they came down and they lost their Lamborghini and their nice apartment in Manhattan, he just bought the share price where they were bottomed out and up he went again. Yeah. And, he was really disciplined and he understood those fundamentals really well. What are a couple of, maybe let's move to a different fundamental that's key to the algorithm, to the quant that makes Portfolio Coach work for me. subscriber, as a user that goes in on a Saturday or a Sunday, understands which players I need to move in and out of the game by buying or selling. What are a couple other fundamentals that are critical to what you guys are doing on the inside every day to protect my wealth, grow my wealth by following your coordinating, you might say? You're my offensive coordinator. You're telling me my plays to run in and out.
Yeah, one of the things we look at is moving average. And so moving average, and you'll hear it a lot if you do any finance stuff, you'll hear about the 50-day and the 200-day moving average. And basically, over a long period of time, a stock's average is going to be, genuinely in an upward, from the bottom left to the upper right type trend. And then on a short-term basis, you look at a 50-day moving average to see what the current trend of that stock is. On a 50-day average, if it's higher than the 200-day average, the stock is going up faster than it had. If the 50-day is below the 200-day, then the stock's going down from where it historically has. So we'll look at that, but certainly not at the 50 and 200-day. We're much more active in that, so we're looking at a much shorter period of time on both sides of the thing. The other thing we really look at is trading volume. If a stock trades 1 million shares a day and it's going up $1 a day, and it's going up $1 a day, and it's going up $1 a day, and all of a sudden is trading 800,000 shares or 600,000 shares or 400,000 shares, and it's going up $1 a day, 80 cents, 60 cents. It's topping out and it's rolling over. You're running out of buyers, because for every seller, there's got to be a buyer. And so as the volume, as the stock is going up and you're getting less volume, then it's rolling over. And we want to sell, and then you're going to see, as the stock starts going down, you're going to see the volume go up again until it gets down toward the bottom. And then you're going to see, again, lower volume because there's going to be less sellers. And so we look at those along with moving averages and convergence, divergence, which is, taking into effect what's going on with the pricing on a tick by tick basis and such like that. But the moving averages and the trading volume really make a big difference for us as far as the quant and algo is concerned.
Okay, good. So we got PE, we've got moving average, we've got trading volume. I think the question is, how do I trust something that I can't see? And maybe I don't understand these fundamentals. How do I trust? How do I trust that it's working? And I'm not going to let you off the hook with a simple answer like, well, I have data for 15 years that shows we're better. Yeah. More viscerally, how do I trust that, given that I might have a little nest egg and I might be risking some of my nest egg? How do I trust that? How do I put the money in, actively trade, and give my heart to that part of my money, and how it works with Portfolio Coach?
Yeah, it's hard because, the subscribers are going to be looking at us for the first time or in a day or a week. And they're not going to see behind the curtain, I guess, to see, the 30 years experience that we've had doing this, and the 15 years that we've been running the algo and the quant, and the signals of I'm looking at 4,000 different signals, or different signals, because I'm looking at 3,000 different stocks and 100 different ETFs, and without computers, none of this could happen, because I can't analyze, those 4,000 different variables on a daily basis on what's going on each of the stocks and ETFs. The computer is self-learning. It's AI driven. But I don't know. How do I trust it? I have the experience. The first time that we did it, we questioned it a lot. There were times back in 2010, well, even 2008, after it had crashed, we got a bunch of buy signals in March of 2009. The last thing you want to do is do a bunch of buys in 2009, because the stock market's down 60%. We did it. and the program turned out to be right. And so at that point we had a lot more trust in the program. I guess what has to happen is the subscribers, as the market's going up or down, will look at their own experiences to decide. When it says sell Apple, Microsoft, Google, Facebook, Tesla, and you're thinking, why? The market hasn't gone anything but up. But, we get sell signals on that 6 months ago, and now all those stocks are down 30, 40% of where they were. Now all of a sudden they're going to have more trust. So really to go all in is going to take, some time for them to trust the signals and watch what Portfolio Coach saved them from losing, I guess, more so than anything else. Everybody can make market money when the market's going up. That's the buy and hold philosophy. You buy all those stocks and you just hold on to them no matter what happens. But why participate in those losses if there's a product out there that can, is designed to help you, lose less so you'll make more. And that's what Portfolio Coach was designed to do.
That's great insight. I think that sort of hits on the idea of some of the softer fundamentals, the non-analytical, the non-mathematical signals is the idea of and I think this is a way that Portfolio Coach really protects you from yourself. And I bring it back to my mentor in my investments classes when I was in college. We spent the first 3 months of our investment training reading case studies and learning about psychology. And the remainder of the time, we spent understanding analytics. We spent time understanding fundamentals, how to trade. And then we actually traded. There was an endowment there. He gave us cash. It was a sink or swim thing. If you succeeded in your investments, you got to pass the class. If you didn't, well, better luck next year. Or you might go get a liberal arts degree or something. Not that there's anything wrong with liberal arts degrees for those of you who are listening, but my dad has one, so I'm not critiquing, but it was fascinating that what we got frustrated with in understanding psychology and behavior, Portfolio Coach helps to manage that by saying, I'm going to make it simple. If you buy now, you'll be happy. If you sell now, you'll be happy. You may not see it tomorrow. It might be a few weeks, but that 30 and 50-day moving average, the book trading volume, PE ratio, those fundamentals that tell you how the market is behaving in general, in broad brushstrokes, they protect me. They protect an individual by telling me buy, sell. And it's as simple as that. I go in on a weekly basis, buy this, sell that, hold that, and I'm protected. I'm insulated from some of those insecurity behaviors or enthusiasm behaviors that can be actually detrimental to a portfolio's success. Because emotion plays a huge role in our markets.
It does. Human nature is, and it takes place even here in the office, and we just can't override the program. There's FOMO, the fear of missing out, and the fear of missing out is basically causing you to buy high. And then what we did we were having issues with in 2009 was the fear of buying in when everything looks so bad. And but the computer doesn't have emotions. It just looks at numbers, and numbers don't lie. Emotions do. And so you want to buy low and you want to sell high, but human nature is buy high and sell low because you want to go into protection when you're at the bottom, and you want to buy because everybody's making money at the top, and that's exactly the opposite of what you should do. And the computer takes the emotions out, so our signals are emotion free, I guess, which is a great thing to have.
On that point, I want to bring this episode to a close. And we're going to do a fundamentals 2. We're going to dive into some more of that analytical stuff, some more of that foundational stuff that makes Portfolio Coach such an asset to me as an individual. Your insights have been fantastic today, and I look forward to following up on the next round. We got a lot more coming up. We got sectors analysis coming up. We've got more fundamentals analysis coming up. And as we go along, we're actually going to start to dissect some of the weekly performance, do some week in review stuff so that anybody can see what's happening in Portfolio Coach on a given basis to help build that trust and why this is such a valuable asset. So Derek, thanks again for your time. Let's get you back to, doing your thing so that we can continue to add value to the clients.
Hey, I appreciate it. It was great seeing you and look forward to next time.
Visit get.portfoliocoach.com to get 90 days of gold subscription for free.